Edison Leasing leased high-tech electronic equipment to manufacturer Southern on January 1, 2018. Edison purchased equipment from International Machines at a cost of $112,080. When they lease their asset out, Edison is the lessor when they lease out asset to manufacturer Southern. They lease out it for 2 years, and the lease payment is collected 8 times for these 2 years because it was collected 4 quarters a year. Each quarter they will collect $15,000 of rental payment from lessee, and if they sell this asset, they will sell $112,080, so they are not making any selling profit. Their cost of buying this machine is $112,080, and the selling price of this machine is also $112,080. Now we are asked to prepare amortization schedule. The initial balance will be the price of the asset. So $112,080. Lease payment is already given $15,000, and it is paid at the beginning of every period. So on the same date, the contract starting date, there are 2 lines. One line for the initial balance, another line is the cash received that will reduce the balance lease receivable balance. There is no interest accumulated because these 2 rows represent the same date. So decreasing balance will be 15,000 minus 0, 15,000 still, and therefore your lease balance is decreased by $15,000. Next payment is on April 1st. Still lessee paid lessor $15,000. But this time, there was 3 months passed. So we will take previous balance, multiply by interest rate. Interest rate in this example is 8%, but this 8% represents whole year interest. Here I only need to capture 3 months of interest. 3 months of interest is 1/4 of the year, so we multiply by 2%. The interest revenue for lessor is $1,942. We round to the dollar. Then the difference between cash payment and interest revenue is the amount we will decrease lease receivable. Connect automatically calculates outstanding balance for us so that we can speed up our process. July 1st interest revenue will be previous balance multiplied by 2% of interest rate. This is a quarterly rate, so 1680. We don't even need to calculate the decrease in balance column. Next period, the interest will be 7702 multiplied by 2%. $57,116 is previous balance multiplied by 2%. So January 1st, 2019, we have interest revenue of $1,142. The next period, April 1st, we have E15 interest revenue. And then July 1st, we will take the balance from last period, multiply by 2%. So that completes this amortization schedule. And then the journal entry will be based on my amortization schedule. January 1st, when we record the lease, the lessor has lease receivable of the lease fair value $112.80. On the credit side, they lease out equipment, so we will credit equipment. Next one says, on the same date, they receive cash of $15,000, and this $15,000 reduces our outstanding balance for lease receivable. April 1st, 1 quarter later, they receive cash of $15,000 again. This time there is interest revenue because three months of time period has passed. So go back to my amortization table, requirement 1. April 1st, we have interest of $19.42. And the lease payment, lease receivable is reduced by $13.58. So my journal entry for the third one, April 1st, is interest revenue of $1,042 and lease receivable reduced by $13058. On July 1st, amortization table 2018 says 1680 and 13,320. So my April 1st journal entry. July 1st, we have a cash receivable, cash for $15,000 and interest revenue and lease receivable. Of 13,320. And October 1st, 2018, 1414 and 13,586. So we have cash again, 15,000, and interest revenue and lease receivable. And the lease receivable will be the amount to decrease the balance. So lease receivable here is $13,586. December 31st, 2018. Let's go back to schedule again. December 31st, 2018 is the balance on January 1st, 2019. So the interest is 1142 and lease receivable is 13,858. But be careful. At the end of 2018, it's the date of preparing financial statement. It's not the date of paying the lease or receiving the lease payment. This January 1st is the day to receive payment. So on December 31st, they won't get cash. They will only have interest being accrued. So interest receivable and interest revenue. Interest of 1142. And then on January 1st, 2019 is the day they actually receive cash. So they debit cash of 15,000 and then retire the interest receivable because now they receive the interest. This time interest receivable should be on the credit side for the amount 1142. And then the remaining amount is the lease receivable, 13,858.